Hey everyone, Tim Storm here. Rates are unchanged for the week, but that was after a few rough days on the bond market on Monday and Tuesday. Once we got the much anticipated May 10th CPI update, rates began to improve. Now, mortgage rates follow inflation, and the continued improvement in CPI has been a good sign for mortgage rates. The experts that I follow believe that we'll continue to see improvements in CPI through the summer, which will be great for mortgage rates, which should continue to improve. Now, good things to come, at least for mortgage rates. We've got big news from FHFA this week. A few weeks ago, I mentioned the loan level price adjustments, or LLPAs, and how the new adjustments were not as bad as the media was making them out to be. A borrower with good credit and down payment is still paying much less for a mortgage than a borrower with a lower FICO score or less down payment. But a new LLPA based on debt to income ratio, which had been delayed back in March, was set to come online in August. The DTI LLPA was a terrible idea because it was going to be extremely difficult to implement. Rates quoted and locked at the beginning of escrow could actually increase by closing just based on a high homeowners insurance quote. Well, FHFA listened to the mortgage industry for once and pulled back on the DTI LLPA. And that is excellent news. Now, the question for this week is on confusion between a bank statement program and a DSCR program. Now, a bank statement program allows us to qualify a borrower using cash flow on their bank statements instead of reviewing pay stubs, tax returns, and W-2s. Bank statement programs are available for primary residences and investment properties. There are so many different types of bank statement programs. I'll have to make a separate and longer video to go over it, but these are great programs for self-employed borrowers or someone who will have a tough time with income verification. The DSCR program, or debt service ratio program, is only for investment properties. It cannot be used for a primary residence, and the reason is because qualifying is based on verifying rental income will be enough to cover the monthly PITI payment. Now, DSCR programs are great for investors who have the down payment for an investment property but won't qualify using conventional Fannie Mae Freddie Mac guidelines. Most DSCR programs require at least 20% down, and the rates vary based on LTV and FICO scores. There are even DSCR programs that will allow the usage of short-term rental income and just an estimate from AirDNA. If you would like more information on how a DSCR program or bank statement program can help your clients, please reach out to me today. Hope to hear from you soon.